What's going on, everyone? Welcome back to Financial Knowledge, where I bring finance and investing related advice. In today's video, I'll be sharing my personal opinion on passive and active investing, discussing some of the benefits and disadvantages of both investing strategies, and making some recommendations on which might be best for you. Understanding these two strategies is key to being a good investor, and I think both definitely have their place in everyone's portfolio. Remember, if you find the content useful or want to help support the channel, feel free to leave a like or subscribe, and let me know in the comments which investing strategy you prefer. Are you someone who likes to spend the time understanding a business and researching a company as an active investor? Or do you prefer a set and forget strategy but an overall lower annual return with a passive investing strategy? Now, without further ado, let's get into the content. The first investment strategy that I'm going to cover is passive investing. Now, with passive investing, you're not trying to beat the market by putting your money into individual companies. You're just participating in the market. So with this investment strategy, you might put your money in an index fund, which will just track the changes that occur within the stock market. So something like the S&P 500, for example, which tracks the top 500 companies in the US. When you put your money in an index fund like this, your investment is spread out amongst all of the companies that make up that index fund. If you put $1,000 into the S&P 500, that $1,000 would be distributed amongst all 500 companies that make up that index. This is considered a safer investment strategy because as your money is spread out amongst different companies, if, say, for example, the healthcare sector was reducing in value and the amount of profit from that area was diminishing, the technology sector might be thriving and doing well. They will sort of balance each other out. You get a consistent growth over time, which is estimated to be roughly 7 to 10% per year. Now, this leads to the downfall of passive investing because while it is considered a safe and consistent strategy, the overall return that you can make is relatively low and is not as high as the potential return you can make with active investing. Passive investing is quite useful for beginners who just want to get started in the market and see what it's like to put their money into companies but don't really want to take the risk or put in the time to research companies, because if you start reading a 10K report or going on websites like QuickFS to look at the equity or the sales rate for companies, or begin listening to conference calls or read letters to the shareholders, when you're first starting out, that can be quite a daunting and also time-consuming process, which can put a lot of people off active investing. So as I said, if you're starting out and you're a beginner and you want to see what it's like to invest in the market and get an idea of what the stock market's all about, and passive investing can definitely be a beneficial strategy for you. Now, moving on to active investing. When you actively invest, you're essentially trying to beat the market by selecting an individual business to invest in and aiming for that return to exceed the average annual market return of 7 to 10%. With active investing, a good benchmark to have is a minimum return of 15%. So with this benchmark, you will double your money every 5 years. As the name describes, active investing requires far more input from the investor in relation to understanding a business, researching the financials, looking at income statements and balance sheets, having a good knowledge basis of how the business makes money, what are its risks, how does the management work. All these things play into what companies you're willing to put your money in. And for a lot of people, as discussed earlier, this can be quite a time-consuming thing, so this can deviate people to prefer the passive investing strategy. However, active investing has the potential for far greater return and can far exceed the 15% return which you're aiming for. It is possible to double or triple your money or make an even greater return than that with this investing method. However, this is not guaranteed, and I'm not saying that it's something which always happens or happens often, but there is a potential for it to occur. And for me personally, I'm happy to take the risk of putting my money in an individual company, but being able to reap a potentially far greater reward. With active investing, you will participate in all the wins and losses that this company you've put your money in will undergo. And what a lot of people do is they'll diversify their portfolio and put their money into several individual companies to try and emulate the benefit of an index fund. So having an investment in healthcare, having one in technology, having one in hospitality or tourism. So they spread out their money across various sectors, essentially trying to create some security for themselves by putting their money in different areas. So if one sector of the market is doing poorly, another sector will be doing well, and they'll balance each other out, similar to what happens with an index fund. I think both passive and active investing have their place in everyone's portfolio, and if you have a balance between the two, it can give you quite a bit of security in where you put your money. Personally, I like to have 20% of my money in passive investing, so in index funds that are diversified across multiple companies, and then I like to have the other 80% of my portfolio based on individual companies with the active investing approach. I hold about 6 individual companies to try and give myself a bit of security with the active investing strategy, but holding 20% of your money in index funds balances out your portfolio and can diminish some of the risk associated with the strategy of selecting individual companies and offset some potential losses. But ultimately, what gives you the most security with investing is having a long-term value investing strategy like the one used by Warren Buffett. Even with the individual companies, you want to think to yourself that you're going to hold these for 5 to 10 years and only invest in high quality business that have a strong financial outlook for a long period of time, and only purchase them at a margin of safety price, so you're aiming for 30 to 50% below the company's intrinsic or fair value. This will give you the most security and protect yourself from a lot of financial stress and challenges that can come with investing. And this is overall the main thing you should be focusing on when you're selecting businesses and thinking about where to put your money. Spending time in the market is better than trying to time the market. Trying to make short-term predictions on what stock will rise quickly or which one is at risk of falling is a challenging way to try and make money, and the long-term value investing strategy is what will give you ultimately the most security. Well, that wraps it up for the video. I hope you found the content useful, and this video has given you some context on what passive and active investing is, and you can use this information to improve your portfolio and start making some greater returns. I'll see you guys in the next video. Thanks for watching. If you want to subscribe or watch any more videos, feel free to click the links on screen.